Okay, so something that's quite a big deal for business owners is, especially SMEs and small business owners, is dividends. There's a little bit of confusion. I don't think this is one of the majorly misunderstood elements of running a business, but people who are new to a business sometimes struggle with this a little bit. So just to be clear on what a dividend is, how it works, how you pay it, the tax rates you pay on it, let's do a little bit of a deep dive into dividends. So this is the P&L of your, well, not your business obviously, but this is a P&L of a business, right? So one of the questions I sometimes get from clients is where are the dividends on my P&L? The simple answer is there are no dividends on your P&L. The reason for that is that the P in P&L, as you can see here, stands for profit, and dividends are a distribution of profit. So you have to calculate your profit before you can calculate the distribution of that profit. So that doesn't mean it doesn't have any place on your P&L. I do run management accounts for some clients that like to have a separate line at the very bottom here for the dividends they're planning to take out of their business. However, it's not an element, it's not a profit calculation, and that is something that some people that are new to running a business don't understand. It's not an overhead, it's not a cost. Obviously, it's not deductible against tax, so it's something that doesn't generally appear on the P&L. If it does appear on the P&L, it's at the very bottom underneath the profit calculation, because it has to be. It can't be part of your profit calculation because you can't distribute profit until you've calculated that profit. So by definition, you can't include dividends in your profit calculation. So that's the first thing to sort of clarify. The second thing is what a dividend actually is. I mean, obviously, I've just said it's a distribution of profit. So this also covers the availability of dividends. So obviously, if you have a job or if you work in a business, generally speaking, you have a salary. So salaries in a P&L would normally be up here under direct labour if it's a direct cost of cost of sale, or it would be down here in administrative salaries if it's not cost of sale but it's an overhead. It's maybe a manager's salary. So that's where salaries would normally appear. Now, if you're the owner of the business, as in a shareholder, you must be a shareholder to get a dividend. I've seen videos on TikTok and so on talking about directors taking dividends. It's not, a director isn't always a shareholder. So the terminology, you've got to be quite careful with it, because I have seen people take a role, even people take a job as a director thinking they're going to be able to take dividends because they've read that somewhere. Dividends are only payable to shareholders of businesses, not directors. So with that in mind, if you own the business, you have the option to pay yourself through dividends or salary. So you could put your salary in here. What a lot of business owners do is take a salary up to the tax-free threshold, so the personal allowance that everyone gets every year, where you can earn a certain amount of money before you start to pay tax. A lot of people who own businesses take a salary up to that level because a salary reduces the profit of the business and therefore the corporation tax. So if you're the only shareholder of a business, let's say you've got a really small business and it's just you. So you're the shareholder of that business, so you own the business, but you're also, if it's a limited company, an employee of the business. That's another key thing that people sometimes misunderstand. If you're a limited company, you are not self-employed. You are an employee of that limited company. You also own it, but you're an employee of it. If you are a sole trader, then you're just, everything the business earns is your money. You and the business are the same entity. With a limited company, the owner of the business and the business itself are two separate legal entities. It's a very important distinction. So everything I'm about to say is relating to limited companies, because you can't take dividends from a sole trader, if you're a sole trader, I should say. So with that in mind, if you are the shareholder, if you're the only shareholder of a business, let's say it's a relatively small business, it's just you and you're doing, let's say, marketing for other businesses. So if you make a profit, then your business will pay corporation tax on that profit. You personally will pay tax on any money you take out of that business as a salary or as a dividend. So it seems like it's hitting you in the pocket twice, but actually that's why dividends are taxed at a much lower rate, and that's why most business owners choose to take a minimal salary up to the tax-free threshold and then take dividends after that point, because they will pay tax on the dividend, but they've already paid tax on they've already paid corporation tax through the business. So that's why you get a lower rate of tax on a dividend. So the way that works is your salary element will be in here, but your dividend element will be off the P&L down here somewhere if you choose to record it that way. So we'll look at tax thresholds and rates shortly, but in terms of what you can take as a dividend, that's another area where there is sometimes a little bit of confusion. So let's clear that up. So this number here, 16,543, is the profit made in that month, in 1 month. This is January 2021. This is the P&L for that month. So you've made £16,543 profit in 1 month. So that money is net profit, but it's importantly, you need to bear in mind that there's no tax paid on that yet. So dividends are a distribution of post-tax profits. So you have to pay your corporation tax, and then whatever's left is available for distribution as a dividend. So I know that doesn't necessarily make a whole load of sense in the context of a P&L, so let's look at the balance sheet. So what we've got here is that's the 16,543 for January. So this balance sheet is dated as at January 2021. So the 16,543 that you made in January is in there, but you've also got retained earnings of 35,744. So the total of that is £52,287. So that is what is available for distribution to the shareholders of the business. If you're the only shareholder, then that's yours. That is the retained earnings of the business. The reason this is shown on two separate lines is because this line, retained earnings, relates to previous years. But the crucial point here is that tax has already been paid on those earnings. So that 35,744 is all available for distribution as a dividend. The 16,543 is not. There's no tax paid on that yet, so you can't take the full 16,543 out of the business as a dividend. The tax rate at the moment in the UK is 19% if you make less than £50,000 profit. So based on that, the profit available for distribution there, 16,543 minus 19%. So the actual profit, the actual element of that profit that is distributable as a dividend is 13,400. Recently, last in 2023, HMRC changed the corporation tax rate. If your business makes more than £50,000 profit, then the corporation tax rate increases to 25%. So given that you've made 16.5 grand in 1 month, there's a good chance that you're going to make more than 50 grand this year. So you need to be careful if you're allocating money to dividends throughout the year, or if you're taking interim dividends, as they're called, throughout the year. Because if you I've just taken 19% off that, and it's 13,400. However, if you took 25% off that, obviously it would be a bit less. So you need to be careful taking money. I mean, you could actually end up making a loss that year, just because you've had a great month in January. Maybe you're a greetings card company and people are buying loads of Valentine's Day cards, but then the rest of the year could be really flat and rubbish, and you might end up losing money overall. So who knows? It depends. So the key point is that the 35,744 is available for distribution as a dividend, because the tax has been paid on it, the corporation tax has been paid on it. It's available to be distributed. The 16,543 technically is available for distribution, but you do need to be mindful that you may not make a profit this year. Just because you've done well in January doesn't mean that you're going to end up with a profit for the end of the year. And that's a real key point, because if you get to the end of the year and you end up making a loss, then not only will that 16,543 not be available, but the 35,744 might not be available either. So let's say if you end up making a loss of £5,000 this year, then you can only take the total of your retained earnings. So currently the retained earnings in this business is the 16,543 plus 35,744. So it's 52,287 is the total at the moment. However, if this business ends up making a loss at the end of the year of, let's say, £5,000, then the total distributable reserves at that point would be 30,744. And if you've taken interim dividends during that period that exceed that, then you're going to have what they call illegal dividends, which is where you've taken a distribution of profit out of business that didn't have enough profit to distribute. So you need to be very careful with that. It's not the end of the world. You can restate that as a director's loan, but you need to be very careful and not overtake your dividends knowingly. But generally speaking, if you're the only shareholder in a business, whatever profit is made, once the tax is paid on it, it's yours to take. So with that in mind, let's look at the implications of taking money out of a business as a dividend. So currently there is a dividend allowance, which is a tax-free amount only applicable to dividends. So in general terms, all your earnings are pooled. When you're talking about higher rate, basic rate, additional rate, the earnings are pooled to determine which rate is going to be applicable. Currently, the dividend allowance is £500 for the year. So on top of the personal allowance, which is currently £12,570, you get the first £500 of any dividends tax-free as well. So after that point, the tax payable on the dividend is 8.75%, and the PAYE equivalent is 20%. So PAYE basic rate is 20%. Dividend basic rate is 8.75%. So you can see why that's an attractive option if you own a business and dividends are available to you. The second rate on that would be the higher rate. So once you exceed the higher rate threshold, which is currently £50,270 a year, once you've exceeded that, and I don't mean in dividends, I mean in total earnings. So if you take a mixture of salary and dividends, then that threshold is the combined earnings, not just dividends. That's an important point. But once you exceed that threshold, the higher rate dividend tax is 33.75%. And then the additional rate, which is for real high earners, the additional rate threshold at the moment is 125,140. So if you earn more than that in terms of combined income, then if you take a dividend, the rate will be 39.35%. And that obviously compares to PAYE at a rate of 45% for additional rate taxpayers. Now, bear in mind, it is only the portion of your earnings that is over that threshold. So if you earn, let's say if you earn 55,000 and you take a mixture of dividends and salary, then the portion of dividend up to the threshold of 50,270 is payable at 8.75%, and it is only that additional 3,000 odd that would be payable that would be taxable at 33.75%. So it's not, if you cross the threshold, all your earnings are taxable at that rate. It's literally just the portion of it that's over the threshold. So you can see why, the reason that as I said earlier, the reason that the dividends are taxed at a lower rate is because you've already paid tax you've already paid corporation tax on the profits of the business before they're distributed. So, it's a bit of a sort of trade-off. And this is quite an emotive issue. I've seen on social media people, every time somebody puts anything on there about dividends and the tax they pay on these dividends, there's loads of people haranguing them about it and, saying it's a tax dodge and so on. I'm not going to weigh in on that. I don't agree with it, but, each to their own. Do your own research and feel however you feel. But anyway, the most common way that company shareholders pay themselves at the moment is a salary up to the threshold of the personal allowance, which is currently 12,570, and then as soon as tax becomes payable above that rate, they tend to switch to dividend because it is 8.75 instead of 20%. Now, the other thing to bear in mind when you talk about dividends is that they are payable in proportion to shareholding. So if you're a 100% shareholder, you could take as much of the distributable reserves as you want to take, as long as you don't breach as long as tax has been paid on it and you don't overtake the amount of profit available in the business, then good luck to you. Take as much as you want. The only there are restrictions though if you're not the only shareholder. If you and let's say you and your wife own the business 50% each, then if you declare a dividend, you both must have 50% each. So if you declare it, I mean, you know, this is basic stuff, but if you're declaring a £10,000 dividend, for example, 5,000 has to go to each shareholder because it's 50-50. That's pretty straightforward because it's 50-50, but I've seen some very convoluted shareholding arrangements in the past where, you know, there'll be a majority shareholder who has 82%, and then there's 50 other shareholders that have 0.something% each, and it can get very, very complicated calculating the split of dividends. Now, there are a few other considerations around dividends that we're just going to cover off. So they can be waived. So now, why is that important? So let's say, as previously mentioned, you know, one shareholder let's say there's an 80-20 split. The 80% shareholder must have 80% of the dividend, and the 20% shareholder must have 20% of the dividend. However, if there's not enough profit in the business for the 20% shareholder to receive a meaningful amount, then the 80% shareholder can waive their right to a dividend. We're not going to get into the details of it in this video, but yeah, it's an option. So if you do want to pay a dividend to some shareholders and not others, as long as they agree to it, you can't force people to waive a dividend, but if they agree to it, they can waive their dividend after it's been declared. You can also, to get around the proportional shareholding element, you can also have different share classes. So you can have A share, they're called alphabet shares, which is a bit of a colloquialism, but you can have A shares, B shares, C shares, and so on. And they can have different dividend rates attached to them. So that's another way. If you're going to be regularly declaring a dividend to one party but not another, that would be a good way to do it, because the dividend rights can be varied on different share classes. They must be declared at a board meeting. It has to be minuted that a dividend has been declared, and also it can be declared at one point and paid at another. You could declare a dividend in July and not pay it until September, for example. The declaration and the payment don't necessarily have to be at the same time. Dividend vouchers. So if you declare a dividend and pay a dividend, you must issue a dividend voucher to the recipient, because it's something they need for self-assessment tax. So that's it really, that's dividends covered. If you have any other questions about dividends, we have another video about different ways to take money out of a limited company. Dividends is just one way of doing that. So if you have any other questions about dividends that aren't covered in this video, feel free to reach out. Thanks.